Hey, everyone here at the Investing Stuff You Should Know podcast. We got an exciting guest with us today, Danny Bellish. Hopefully, I'm not mispronouncing his name. Danny lives in New Jersey with his wife. His anchor market has been kind of New York City, New York area, New Jersey area. But he's got an exciting story. His how they were in corporate and then they partnered into kind of step right into syndication pretty quickly. This resonates with a lot of my audience where people they want to be in real estate, but they don't know whether it's active or passive. And also there's that bridge challenge of how and should I get from or go from corporate to perhaps real estate as a side hustle or maybe full time. So Danny's going to break that down. So Danny, thanks for being with us here today.
Yeah, you got it, Johnny. I appreciate you having me.
Awesome, Danny. Awesome. Let's again, like I said, but people want to hear it from your mouth. And also, why should they listen to Danny? Just give us a couple of highlights that intrigue and that share. Like maybe I'm just maybe you, yeah, maybe you've done other things, and people want to know why should I listen to this guy about real estate, investing, and even your corporate life. So share a little bit there.
Yeah, sure. Again, appreciate being in front of you all. And it's a pretty wild story that my wife and I have been on over the last several years. I've been in the 9 to 5 my entire career. And I worked in the New York City corporate advertising world, advertising marketing. I still hold a W-2 with Disney, heading up their digital and social advertising strategy.
Is it just a quick sidebar there,
Yeah.
Danny? Is it basically is everything about New York? Is that just always like super high pressure? There's so many like shows and whatnot set in there. Is that like the pinnacle? Everything is like super intense, like marketing and advertising and record, like all this stuff. Is that true? Is it like
Everything
everything?
TV is 100% true.
Okay, so and everything's like epitomized there. It's distilled like the most ruthless climbing to the top and getting what you need and the best of the best. That's how I think of New York.
You know what? A lot of that is true, right? Because
Yeah.
it's so densely populated. There's so many people that want to be here. There's so many industries that are here and anchored here that it makes for a competitive and demanding space where you have to be climbing to the top at all time. It is an absolute rat race. But it teaches you so much about how to conduct business on a B2B level, on a
Yeah.
B2C level, on a C2C level, that we have been able to take our corporate experience and apply it to our real estate investing business that we now do all over the country.
And I think
So
that's
it's part of
important.
our New York City hustle that helped us get in with folks who have a wealth of experience, decades of experience, and hundreds of millions of dollars worth of assets because of that skill set.
Yeah, and I think that training, just like an internship or a co-op, I think that training, if it, in a larger sense of life, is so intense and happens so quickly. Well, I think that's a part of the compelling story of you're in this really intense and competitive environment, and then you were connected and you're working at a high level at your job. And then that just shows the kind of trial by fire that you guys have learned and thrived. And then, of course, a step through that. It's awesome, man. So give us the first, we had a little pre-chat before the show. Give us the first foray into real estate investing. And obviously, I think you said you were in corporate, and then I think we need some additional income, some maybe some time freedom, and that kind of compelled you. Give us that story there, and then of course that first nugget of what went wrong if it did go wrong. So we'll leave that one.
Yeah, sure. Like I said, my wife, Christine, and I are from the New York City advertising world, that really hardcore grind, but we were doing really well. We were high income earners, but at the same time, we were working our asses off. And we, like probably a lot of your listeners, don't want to always trade their time for money. We started trying to be more savvy about how we were going to invest so that we could have more passive income. We could create more generational wealth. We could have more time freedom to do the things that we want to do in life, because frankly, anything is possible. You can really make anything happen out of nothing. So we started by having my wife leave her corporate job. She actually got let go as part of a large layoff at her company, and she got a severance. And we said, hey, let's use this as our catalyst to move into real estate investing, which is something that we've always been interested in.
Yes.
It happened to be the same year that we were getting married. So there's nothing like losing your job, starting a business, and getting married all at the same time. No big deal.
Yeah.
But so essentially what we did was we started by getting our real estate licenses in both New York and New Jersey, just so that we could get a better understanding of how things work contractually. We could meet sort of lenders, brokers, insurance people. We can really get more familiar with the space. But our first foray into real estate investing was buying a duplex, 100-year-old duplex in a really cool beach town in New Jersey called Asbury Park.
Just a sidebar, I'm living in a 100-year-old duplex in Minneapolis. It's not cool by the beach, but it is 100. It's over 100 years old. But yeah, so I know the kind. I know the beast. There can be
And
real
I'm living in
beasts.
a 60-year-old duplex also. So I love that we're house hacking. That's one of the bigger pockets lessons, and the lessons that we all know that
It
younger
is.
people should employ in order to start to gain some equity, start to get some experience as a real estate investor, and also keep their expenses low. So I love it.
Totally.
So essentially, we bought this 100-year-old duplex, had this grand idea of burring it, and we ran all of the numbers, we ran all of the comps, we did all of the research that we knew to do at the time. In real estate, you don't know what you don't know. So at that time, we didn't have the experience that we do now, and we ended up working with a total nightmare contractor.
They're out there.
They are out there. They are prevalent. Do your research, boys and girls. He was actually referred to us, but it turned out that he was more of a glorified handyman than he was an actual contractor.
Yeah.
So our budget, we went 50K over budget. Our timeline went from 3 months to 9 months. And this is a 1,200 square foot house, 9 months for a 1,200 square foot house.
You're
And
probably walking there. You're probably walking there like, how you probably walk in there like, how could this small cube of a house or residence take this long to do anything?
100%. We found out he proposed to us that he was doing the work with a team, and he ended up doing all of the work himself so that he could keep all of the money. We found out he was sleeping in the house, to which my first thought was, you're sleeping in the house and you're still behind schedule. I don't understand how this isn't getting done.
Yes.
To make a long story short, we ended up burring out of that project. So for those of your audience that I'm sure they know it, but it's buy, renovate, rent, refinance, and repeat, right? So it allows you to take the equity that you've built in the home out and continue on your way. So we ended up doing that. It's actually cash flowing really well today. But my wife and I looked at each other after 9 months of blood, sweat, and tears and said, how are we going to scale this to a place where we're going to have enough passive income for us both to leave our jobs? And that's where we ended up going to a meetup for purchasing multifamily out of state. And what we thought it was duplexes, triplexes, quads out of state where it's more friendly, better cost basis, better tax rates. And it ended up being about real estate syndication.
And then so you didn't, like folks like us, maybe initially getting into the space, we don't even, that's a weird word. Is it's like something to do with gangs, or we don't know what's going on. Like syndication. Okay. Yeah. And there's movies out there.
Syndicate of some sort.
Syndicate. And I was like, that's strange, but typically that means really large, much larger than fourplex is what that means normally.
Yeah, it was a whole new world for us. And frankly, even 90% of my investors today had never heard of syndication before I educated them on it. So essentially, it's when people pool their money and resources in order to accomplish something bigger. It's not just in real estate. It happens in every industry across the world. In real estate, mostly it's when a really experienced operator, also known as a general partner, is the one who finds the deal, does the underwriting, sources all of the lending, has all of those relationships. They're the ones who raise the capital for the deal, and they're the ones who operate and manage it, and everyone shares in the profits and the equity in the deal. And for the most part, these are large commercial projects. Think anything like a 300-unit apartment complex or a brand new development or a redevelopment or even a retail type property or an office type property. So we're at this meetup, and these folks who had literally $500 million in assets under management at the time, it's more now.
Yeah.
Were telling us about...
Because you've been helping them, Danny.
Yeah, exactly. They were telling us about these projects and some of the returns that they're able to offer, and they were better than the returns that we had gotten on our nightmare project.
Yeah.
So our first thought was, oh my God, that's incredible. But then my kind of New York City skepticism kicks in, and I was like, I don't know, this seems like way too good to be true. I'm going to hand over $50,000 plus of my money, and I'm just supposed to trust you to do this, right?
Right.
So my wife and I did about 9 months of due diligence on not just syndication in general, but these two individuals. and we looked at their track record. We looked at their markets. We studied their strategies. We spoke to their investors. We spoke to their attorney. We were probably the most annoying passive investors of all time, but we knew that this was something that really interested us. So we asked them every question under the sun.
And if I could just pause there real quick, Danny, I think that's a really good message for the audience, for the people that perhaps are looking into getting into syndications or commercial real estate. And you really do have to have a bit of a strategy and a plan. So you need to go on a deep educational spree or deep dive. And that's actually really crucial. But also put a timeline on it, or make it time bound, because some people get stuck in the analysis of the educational piece, and that's where they live until this day. They're still spinning 10 years later. They're still wanting to do that. So just notice how Danny approached, he and his wife did that. Deep education, skepticism, knowing it interested in them, and they knew where they were going, but also put a time, and like you said, 9 months, and then the story continues. But I just wanted to make that point.
Yeah. And for our investors now, where in the span of 2 years, a little over 2 years now, we have over 100 investors at this point, and we get everybody from one phone call and they're ready to invest to people that I talk to for a year and educate them. But that's how it has to be. It's a two-way street. You need to really vet those operators and understand that they are somebody that you know and trust, and that they have a track record that they can stand behind. So we spent all of that time really trying to get to know these guys. Because for me personally, if I'm going to invest that kind of money with someone, not only do I want to trust that they have the right business skills and acumen, but it's got to be somebody that I can get a beer with, I can have a drink with, somebody that I can relate to in that type of way, and that I can call them when I need them and know that they're going to answer. So eventually we felt comfortable enough to invest passively in 2 of their deals. One was an A-class multifamily complex in Dallas, Texas, about 250 units, and another was in Euclid, Ohio, and that was about 280 units.
That was probably a B or C class, something in Ohio then?
That was a C class, but it was a different structure. It was a debt structure. So that was
just real quick. So you sampled both of those, and I think it's important, just real quickly for the audience there, Danny. A class, typically, if it's, new build or A class, sometimes doesn't cash flow as well. And then basically a C class or B class can cash flow. So they can actually fill different buckets depending on what the investor wants to see. But you sound like you sampled both. Explain that, what A class does and typically the investor profile, and what B or C class does and the investor profile that would match.
I think that's a phenomenal question, and it even goes a little bit deeper than that.
Please.
So I think a lot of people want to diversify their portfolio by investing in real estate. But what they also don't necessarily realize is you can heavily diversify within real estate itself also, right? You have multifamily. The 3 businesses that we're involved with is multifamily, new development and redevelopment, and what are called double and triple net lease assets. And those sort of run the gamut of risk reward. So when you're talking about A, B, C, D class assets, that's normally in the multifamily space. And
Correct.
It has to do with the market that it's in, the age of the building, the condition, the level of amenities and things that they offer. Think that an A class is a luxury building in Miami with all the amenities and a doorman. B class might be a few years older, might not have the doorman, might have some amenities, but might be in a nicer area. And you could see as it goes down the line, it gets a little bit more risky from a volatility standpoint. You're going to have to deal with a little bit more, maybe renovations, a little bit more delinquency and vacancy from your tenants. But you're usually buying it at a better cost basis, and there's maybe more opportunity to get a larger return. It's the more work you put into it, the more money you can get out of it. So that's kind of how the multifamily division works.
Yeah, no, thank you. Thank you for breaking that down. That's awesome. The detail and I guess kind of the risk perspective there, and the philosophy. Really, it's a philosophy of investing and how those different things break out. But anyway, so you guys went into that, to an A class in Dallas and a B class, like you said, in Ohio, or C class. Sorry, you said C class. Then I think this is super important here, and this is something that people maybe they struggle with. And then it's, what can I offer right now? I'm not necessarily a professional real estate investor. I haven't been, my dad, I didn't grow up being a broker in a giant city or whatever. What can I offer? Clearly, you guys are confident in your skill set, that of marketing and sales, and perhaps, and that space well. you mentioned at the beginning of the show, Danny, that you guys actually started working or offered to basically work for free. Tell us that story. That was a really cool story.
Yeah. Once we invested in these 2 deals
Yeah.
passively and started to really get to know these guys, and we started receiving quarterly checks, right? So it started to actually happen the way that they had proposed and projected. And it was like a light bulb that went off, that this is the way that we're going to be able to scale the way that we want. And also, this caters a little bit more to our skill set, right? So we come from this corporate background. I don't have a background in development. I can't wield a hammer to save my life. I blame my dad for that, right? But I'm not a very handy guy,
Yeah.
but I'm good with numbers. I came from a sales background and a marketing background. My wife is extremely meticulous and comes from a research background. So we thought that this was maybe a really good avenue for us. But we don't really like starting at the bottom. That's not our forte. Even in our careers, we are personable people, and we tried to go to the most important people in the room and try to make them our best friend. So that's what we did in this circumstance. But essentially, in this business, these guys who have $500 million worth of assets across 7, 8 states, and they've been doing this for decades, they normally don't have the time of day to just be your mentor.
Absolutely not. Yeah.
Yeah. So we
And
were
you could, I mean,
not always
it doesn't think how many people go approach these people. They're successful for a reason. And there's lots of people that want to be their buddy and get in with them and have favors done. And people want to pick their brain. And these people that are at this top level don't do that. They don't have time for that. You need another strategy. And that's not to ask them to pick their brain or talk for 15 minutes. But go ahead, please, Danny.
I totally agree. No, that's a little bit of a misconception, right? I love that people are out there looking for mentors. That is what you should do. But at the same time, you need to understand what it takes to get a mentor at a certain level, right? And we understood that. And we did this with 5 to 7 syndicators before we did this with these guys. But essentially what we did was we did an audit of their entire business. We looked at all of their consumer-facing materials, from marketing, social media, branding. And now that we were investors, we could evaluate their investor relations.
Right.
So my wife and I took it upon ourselves to create an entire presentation for them of how they could make their entire business more efficient, how they could get more investors, how they could reach more brokers to get more and better deals, how they could hire an investor relations manager to give them more time back for them to pursue more deals. And we asked them for an hour of we gave them a few nuggets. We asked them for an hour of their time. We presented it to them, and they absolutely loved it.
Yeah.
And basically we said, we're going to execute this for you totally for free, pro bono, because we want to learn from you guys and we want to help you guys as much as we possibly can. Plain and simple, not asking for anything in return, not asking for a barter agreement, but just saying, let me be of value to you as much as possible.
Yeah, man.
So
that's the kind of play you have to come in. That's the kind of strong hand you have to come in and play with folks to get to skip levels and to be that. Maybe your skill set doesn't match that. I'm not Danny and his wife, and I couldn't just jump into that. You always have something. There's always some level. It doesn't have to be. It does not, and typically it does not have to be at 0. You could jump into some level, some skill set you have now with focus and dedication. You can provide value, like Danny was saying, just pro bono, just boom, here. Take this from me. I'm not asking for something. I'm not asking for your time. I'm not asking you to tell me what to do. Don't tell somebody I'll work for free and then say, what do you have for me? Danny brought this incredibly valuable package and he said, hey, I think I can do this. And obviously the GP were blown away and were accepting, like, absolutely, let's do this.
Yeah, you make a great point. It's tough. Don't ask how you can help. Just try to help. And everybody can help. Everybody has something, even if it's you can be boots on the ground. If they need something at a particular property, if you're a graphic designer, if you come from an engineering background, there are all types of ways where you can offer value or try to see how you can insert yourself in these people's business, because that's what you have to do in order to get them to pay attention to you.
Absolutely, man. So you offer that, so you put that incredible package together, the marketing package. Hey, let's work together. Did that go on for a year? And then, like, what was the result of that? Just move through the story here.
Yeah, so we did that for an entire year. And in that time frame, learning more and more about real estate investing, syndication, multifamily, all these different business types. And eventually we asked him, hey, would it be okay if we GP'd with you, acting as a general partner, basically the operator of a syndication alongside you in an upcoming syndication? And immediately the answer was absolutely. We have a 293 unit apartment complex in Cleveland, Ohio that we're closing. Why don't you come in as our partners?
That's amazing, man. And what was the value proposition on that to take a stake? And many people know this, but when you're on the GP side, of course, the risk is a lot higher. You're responsible for literally the property, sometimes the debt, depending if it's recourse or not. And then of course, but then also the upside is much higher. But yeah, definitely you're growing up from going from LP to GP if that's where the direction you want to go, which obviously it was. What was the value? Why did they let you on? And what did you offer in addition? What was your job and what were you going to do as GPs?
Yeah, so with these guys, they're very down to earth, regardless of how successful they are.
Nice.
So it was a very easy partnership to become involved in, but it is a role and responsibility for each of the GPs to help raise money from passive investors. So they told us the news, we were super excited, and he goes, but just one thing, I'm going to need you to bring $1 million to the table.
Yeah.
And we were like, wow. So it was a $5.5 million total raise. And this guy does that with his eyes closed. But we have never done that before. We've done many multi-million-dollar deals in the advertising business, but never going to our individual network, our friends and family and friends of friends, and asking them to invest it with us in this type of way. And with these types of deals, the minimum to get in is $25,000, $50,000, and some of them are even much more than that.
Right.
So we have a holy shit moment. But at the same time, we got to that point. What are we going to do? Say no? So we were like, all right, let's go pedal to the metal. And we essentially reached out to every person that we've ever met in our entire lives.
Yeah, I know that. I know the feeling. Yeah.
What?
I guess just a quick sidebar there is, of course, you had the direction you wanted to go. You committed, you provided that incredible sense of value. You work for free for a year, of course, and then we're just simplifying things. And then, of course, when the time for the big game happens, you don't just show up and, oh my God, Danny and his wife, they're the incredible people. No, more is asked of you. You're at this level now, that kind of things that people at this level do, then you're asked to participate at that level. So it's like, hey, if you want to be part of this, can you bring $1 million? Can you bring 20% of the equity needed for this deal? And you're like, yeah. You just say yes.
Yeah, just say yes and figure it out later.
Yeah,
and we also asked, hey, what happens if we don't bring $1 million? I don't want to ruin my reputation with you. I don't want to blah, blah, blah. And we had this thing where it was like, you'll owe me on the next one, or if you exceed it by some miracle, we'll owe you on the next one.
That's awesome, man. That's awesome.
So we felt comfortable and confident, and knowing that we had a sales background, and I'm frankly also the type of person that will talk to anyone at any time about anything. Like, I'll shoot my shot at any time, but try to do it in an authentic and genuine type of way. Like, my wife and I really care about people. We want our friends and family to make money, and being able to educate them on how this works makes us feel like we are helping them attain their goals as well.
Yeah, it's not just a feeling, it's a true sense. You can do well for yourself, for your friends and family, and then, of course, investors that come in as well. So to take this kind of the final chapter here, Danny, you and I chatted real quick, and this is a little more specific. Some people may not care about this, but that's okay. I think you recently, or maybe at the beginning, you started a fund. Let's talk just as one fund manager to another. I recently launched one myself. Talk to us about a couple of challenges or some of the challenges you've seen after having operated a fund for a bit.
Yeah, raising capital in general can be challenging until you figure it out, right?
Sure. Did you start to do that $1 million raise? Did you set up a fund for that?
No. So that was a single syndication it was just for that one portfolio of properties.
Okay.
And to make a long story short on that deal, we ended up raising $1.3 million for that deal.
That's astonishing, man. That's even now, I just feel like the excitement of actually hitting that. So kudos to you for that. That's
Thank
awesome.
you, man. I appreciate it. It was crazy. And we saw, wow, maybe this is the part that we're really good at among some other things. So we immediately got into a 291 unit deal. Right after that, we raised $1.5 million for that, or toward that deal, which was a $6 million raise. Then we got into another deal, and then we started our fund, which for your viewers that aren't familiar with the fund model and how it differentiates is usually with a fund, you have conceptually the types of assets that someone is trying to target, right? And they're raising money in order to purchase multiple assets within the fund in order to diversify, but mainly within those target or criteria parameters. So for us, we had only done individual properties, and now we were doing a fund where it's a little bit more conceptual, right? We go to an investor and say, hey, we are trying to raise money in order to purchase assets like these, right? And for us, our fund was focused on double and triple net lease properties, single tenant net lease, they're called. People drive by them every day. They are the Starbucks that they got coffee at this morning. They're the Wendy's that they got lunch at. They're the CVS that they stopped by before they went home. These are usually single tenant structures where you buy the building and the land where a business is operating. And they, at least for us, we're buying these essential businesses. So we're buying like dollar stores like Dollar General, pharmacies like CVS, urgent care and veterinary care centers, even auto services and auto parts stores.
That's the one came to mind, was Babel and oil changes when you were speaking, but I don't want to interrupt the flow there, buddy.
Exactly. So part of the challenge was really, one was educating people on this net lease space, right?
Yeah.
So most people can understand multifamily because they've either rented before, or they know somebody that's rented, they know how the apartment building works, they pay rent and landlord collects money, right? And there's opportunity if there's a gap in the rent of where it is and where it could be, right? With these single tenant net lease deals, it's a little bit different. People start to think about retail, right? And what we are doing is we're buying these essential businesses, and they come with long-term leases, built-in rent increases in the lease.
With large companies, large stable companies. So that's also a plus.
Mostly publicly traded, and they come with corporate guarantees. So they corporate guarantee the rent every single month.
Yes.
And what triple net and double net actually means is that they pay for the majority, if not all, of the expenses.
Right.
So as inflation increases, taxes and insurance and utilities and maintenance, that's all covered by the tenant.
Yeah, so we're working through all these different levels of abstraction here. So like first is, okay, invest in this duplex. Then it's, oh no, invest in this multifamily. Okay, I'm going to give you 50K or whatever the amount is, and I'm going to own a small piece of that. Now we're talking a fund, and this fund buys these kinds of buildings. Now this kinds of asset, and this kind of asset, like my fund is focused on multifamily and self-storage. Yours is even a little more abstract, like these kind of buildings that companies rent from. So there's a lot of explaining to do. That's a huge challenge, actually. So as we do the last little bit here of the show, what are a couple of tips that you have found, and really to shorten up that explanation, that educational piece, so you and I aren't just sitting there rambling on and all this technical jargon for 10 minutes, because we're going to lose people. We will lose people. I'm not following this, right?
Yeah, 100%. A lot of what we do is, like I said, we come from a marketing background, right? Yeah. So we don't wait until our investor conversation our one-on-one conversation with an investor in order to provide them some education on the things that we're working on. So we use social media, we use email marketing, we do a lot of texting and education. Plus, personally, I make myself available 24/7 to people, whether you've invested or not, because I like to be a resource, and I will take as much time as you need in order to understand the opportunities and the risks and how it all works, and understand, what their goals are. Because I could have someone who comes to me who's 65 and a retiree, who's low risk, looking to preserve their capital, not put their money at risk, and they just want a check every single month. And then I would direct them to our net lease business. But then I also meet someone who's 25, they're building their wealth, they want to grow, they want to go a little bit riskier, they want high risk, high reward. And that's when I might advise them to look into development or B or C class multifamily. And it runs every gamut in between. We've been on the GP side of things for a little over 2 years, and we've raised a little over $4 million.
That's amazing. So
it's all been very condensed, I think the way to go about it is don't pressure people unless it's something out of your control. So a lot of this in real estate is we're up against closing deadlines. So in a lot of circumstances, we're not putting the pressure on you. There's a closing date and you're either in or you're out.
Correct. Yeah, that's super important. And that one's kind of a fine line to walk, where it's like, you're not trying to it's not so much of a desperation thing. Like, oh, are you please going to come in? This is the date. It's set by external factors. This is how these businesses operate. There's timelines and closings and escrows and these different things. And then of course, if you want to be in on this deal, this is the timeline, and you have to present some urgency and some firmness, and the people decide not to, then that's okay. But you do have to present that hard date.
Yeah. What I've found for the most part is the majority of people that start down the process are educated by the time I say, hey, it's time to close, or are you ready to move forward? It's just what you said. A lot of people get stuck in the analysis paralysis, which the difference between an individual syndication where there's a firm close date on an asset and a fund, which might be a little bit more open-ended. Like our fund was open for investment for 12 months. So it was hard for me to go to somebody who I knew was ready to invest and say, hey, there's a deadline. Yeah. So kind of made it a little bit more open-ended, and you just have to roll with it. You have to let them do things on their own time. But at the same time, it's okay to say, are you ready to move forward? It's perfectly fine to say that, as long as you feel like you've given them value and educated them on the space.
Yeah, and that's a two-way. It's a win-win. It's a win for you, win for them, and also the educational piece. It's they absorb, they receive, of course, and you rely on them to do your business. They're relying on you to provide a good return. So I think that's a really fair and equitable exchange of value, and it doesn't come across as trying to sell this some kind of snake oil overnight. It's very equitable. I'll probably do it for this time, Danny. I think I've learned a lot. It's really cool to know about you guys, you as a couple, just killing it over there or up there in New Jersey and things there. So what's the best place or spot for people to connect with you on social media, or do you have a podcast, or like you said, I think you mentioned next year on social media. So give us the goods there, and how should people reach out?
Yeah, so we are very active on Instagram and TikTok at the Bellish Team, Bellish with 2 L's. And then anybody who wants can always reach out to me in my email, danny@thebellishteam.com. Like I said, part of being on this side of the business, you have to be extremely responsive, communicative, transparent, genuine. And that's what we do for all of our investors.
That's amazing, man. All right, everyone at the Investing Stuff You Should Know podcast. Thank you for listening to another episode. Hopefully you learned a lot. This space is a bit newer space, and this type of model that Danny and his wife are working with. And of course, their story has been amazing as well. Until next time, everyone, thank you for listening. And of course, leave us a like, leave us a comment, and then spread the word to your friends.